You know how it is you start thinking about your investments, maybe trying to plan for the future, and suddenly you're just swimming in advice?
Oh, yeah.
Every website, every news show, it feels like they have the secret sauce.
Oh, really?
I feel like you need help, but you just don't know who to trust, or even what path makes sense for you.
It's a really common feeling.
Yeah.
The amount of information.
Yeah.
It's overwhelming. And figuring out who's legit, that's tough.
Well, that's exactly what we're digging into today. We're taking a deep dive into investment advice itself, what it is, all the different kinds, and how you can get better at navigating it all.
And we're using a fantastic source for this. Benjamin Graham, excerpts from his work, The Investor and His Advisors.
The legend himself, father of value investing.
Absolutely.
Sure.
And his insights, even though they're decades old, are still so incredibly relevant.
Yeah,
It's kind of amazing.
it really is. So our goal here, what we hope you get out of this, is a much clearer picture of the whole advice landscape. Hopefully you'll feel more equipped to, question the advice you get and just make smarter choices about who, if anyone, helps manage your money.
Yeah, and we'll touch on some things Graham pointed out way back when about the industry. Things that might surprise you are still true today.
Right. So the mission, let's say, is to give you the tools, the knowledge to be a more discerning investor when it comes to getting and using advice.
Think of it like getting a better filter for all those recommendations flying around.
Okay, so let's jump right in. Graham makes this really interesting point, almost philosophical right at the start.
He does.
He says, investing is kind of unique because people actively seek outside advice on the core goal, how to make money.
That's his point, exactly.
Yeah.
A business owner, they'll get advice on marketing or logistics, sure, but they don't usually ask an outsider, hey, how do I make a profit? That's their job.
That's seen as the fundamental role of the owner, right? They want help with the how, the operations, but the profit motive itself is internal. So Graham is saying when we investors look externally for profit guidance, it's a different dynamic than most businesses.
It really is. It makes you pause and think, doesn't it? Have you ever really considered that difference? Why do we seek investment advice that way?
Yeah, it kind of reframes the whole thing. Are we sort of outsourcing something really fundamental?
It's a great question he raises.
Yeah,
And building on that, he then talks about returns, specifically normal returns.
right. His idea is, look, if we accept that investing in securities generally produces certain, let's say, average or standard results over time, then the advisor's main job isn't necessarily magic. It's more about helping you avoid big mistakes and making sure you actually get those standard, reasonable returns.
Exactly. Protecting you from pitfalls, keeping you on a sensible path. He says the problems really start when investors demand more than that.
Or when advisors promise more than that.
Yes. Even worse, perhaps.
Yeah.
That's when expectations get unrealistic. People take on maybe too much risk, or they get lured into things that aren't quite right.
That really hits home, because we all secretly want to beat the market, don't we?
Of course. It's human nature.
But Graham's point is that maybe good advice is often just about achieving solid, dependable results, steering clear of those costly blunders.
That's a huge part of it, in his view,
Very
just
important.
avoiding the big screw-ups. And so, thinking about advice, he then looks at where people were actually getting it in his day.
And there were quite a few sources. Even then, he lists advice from relatives, friends.
Always a popular one.
Yeah. Then local bankers, brokerage firms, investment banks, financial services like newsletters and periodicals, and then specialized investment counselors.
And what Graham found interesting, even back then, was how, well, almost random it seemed.
Yeah.
The sheer variety made him think that investors didn't really have a, quote, logical or systematic approach to finding advice. They were just grabbing it from here and there.
That feels incredibly relevant today, maybe even more so, with the internet, social media, robo-advisors, niche experts for everything.
It's exploded.
Does it still feel like maybe we lack that systematic approach? Are we just overwhelmed by choice?
I think that's a very fair question. More options doesn't always mean more clarity. Sometimes it's the opposite.
So given this messy landscape, Graham offers a kind of core principle for navigating it.
Yes, this is really his central thesis on using advice.
Yeah.
He basically says, look, if you're going to rely heavily on an advisor, you've got two main paths. Path one, stick to really standard conservative investments and get equally standard conservative advice.
Okay, the same fruit.
Right. Path two, if you want to do something less conventional, maybe more aggressive or complex,
Yeah.
then you absolutely need to have deep knowledge of and deep trust in that advisor. You need to be able to truly judge their expertise and integrity.
So it hinges on the investor's own understanding.
Exactly. He talks about the defensive or unenterprising investor versus the aggressive or enterprising one. And the key difference isn't just risk tolerance, it's their own knowledge base, their ability to critically evaluate the advice they're getting.
That speaks directly to the idea of being an informed investor, a learner. You need that foundation to judge others.
Precisely. Your knowledge empowers you to use advice wisely.
Okay, so let's break down some of those advisor types Graham mentioned. He starts with the truly professional ones, the investment counsel firms charging fees. What was his view there?
Well, what's notable is how he describes their approach. It was pretty modest.
Modest? How so?
They weren't out there promising the moon, beating the market consistently. Their focus was more on putting client money into solid, dependable things, stocks, major companies, government bonds.
So less about flashy returns, more about stability.
Exactly. And they generally didn't try to do a lot of market timing, jumping in and out. Their pitch was built on carefulness, conservatism, competence.
Protecting the principal investment.
Protecting the principal, generating reasonable income. He saw them, and also the trust departments of big banks offering similar services, as primarily valuable for shielding investors from making costly mistakes.
Like a safety net.
Sort of, yeah. Providing what a defensive investor should reasonably expect from professional help for the general public.
Okay, that makes sense. Then he moves on to financial services. These are the outfits sending out bulletins, newsletters, market forecasts.
Right. Like Babson's, Standard & Poor's were big names then. He notes they usually cost less than a dedicated counselor.
And catered to a different audience.
Generally, yes. More for people managing their own money, or maybe advising others who wanted information and suggestions, rather than someone to just take over completely.
He wasn't too keen on their market forecasting attempts, though, was he? Especially the technical methods.
No, Graham, being the ultimate value guy, was deeply skeptical. He basically saw market forecasting as, well, not really relevant for a serious investor focused on long-term value.
He called it the art of Delphic phrasing, right?
Yes. Meaning they'd phrase predictions so vaguely they could never be proven totally wrong, hedging their bets.
Clever. But he did see some value in them.
Oh, absolutely. He acknowledged they provided useful analysis of business conditions, economic trends. That kind of intelligence helps markets become more rational over time.
And they gathered data, right, the statistics needed for analysis.
Crucial function.
Yeah.
But he was quite critical of their common approach. Buy when near-term prospects look good, sell when they look bad.
Why was that a problem for him?
Because it completely ignores the underlying value of the stock.
Yeah.
Is it cheap or expensive relative to its long-term earning power? That focus on short-term news, he felt, often missed the bigger picture.
So use them for info, for ideas, but don't let them make the decision for you.
That's the essence. Use your own judgment, always.
Okay, now on to a huge source of advice. Brokerage houses. Stockbrokers.
Yes, a massive amount of advice flows from them. Graham raises a fundamental question here. Are their customers truly clients in the professional sense?
Because of the commission structure.
Yeah, exactly. While there are ethical standards, the business model historically, and often still today, relies on generating commissions from trading activity. Buy, sell, buy, sell.
Which creates an inherent conflict, potentially. What's best for the client's long-term wealth might not generate the most commissions for the broker.
That's the tension. He notes that succeeding through frequent trading, or speculation as he called it, is incredibly difficult for most people.
He talks about the different roles within brokerage firms, too. The customers brokers, who we might call account executives now.
Right.
And the financial analysts doing the research.
Yeah. He notes the brokers are generally decent folks, bound by rules, but that commission incentive, it naturally nudges them towards suggesting trades.
So if you don't want that speculative push...
Be very clear with your broker about your long-term, value-focused strategy. Set the tone.
And the analysts. As an analyst himself, he must have had strong opinions.
Oh, definitely. He saw their role as vital. Deep dives into companies, comparing securities, forming opinions on safety and value. But he was also critical.
How so?
Well, first, he found it odd there weren't strict requirements to be an analyst back then, unlike brokers who needed licenses, though many had good training.
But the main thing was?
The main thing was that the value you get from an analyst depends entirely on asking the right questions.
Meaning?
Meaning questions about long-term value, earning power, safety margins, not just where do you think the price is going next week.
Okay. Focus on fundamentals, not just market noise.
Precisely. He felt many analysts were pressured to be market forecasters anyway, but their real contribution should be assessing intrinsic worth. He did mention the CFA designation, Chartered Financial Analyst, as a positive step towards professionalism.
Now, this next bit is interesting. Graham added it in a later revision, concerns about brokerage firms actually going bankrupt.
Yes, this was in the late 60s, early 70s. And it was disquieting, as he put it, because it happened despite supposedly better controls and often during periods of high trading volume.
The initial excuses didn't add up for him.
No. First, they blamed being swamped by volume. Then they blamed falling volume. It seemed contradictory. Graham suspected something else.
Which was?
He pointed to partners speculating with the firm's own capital, often in risky stocks. So when the market turned down, that capital vanished, leaving the firms exposed. He called it inexcusable.
Wow. And this led to some very direct advice for regular investors.
Very direct. He basically said, if you're not trading on margin, borrowing from your broker, you should seriously consider having your securities held directly by your bank, not the brokerage firm.
For safety.
For safety. For an extra layer of protection, especially given those stability concerns at the time. It's a reminder that where your assets are held matters too.
Good point. Okay, next up, investment bankers. The ones who handle new stock and bond issues, the IPOs and such.
Right, the underwriters. They play a crucial role, helping companies raise capital for expansion, which fuels the economy. Active markets help this process.
But he draws a distinction in how they deal with different buyers, doesn't he?
Yes. When they sell to big institutions, banks, insurance companies, those buyers are sophisticated, they do their homework, ask tough questions.
But individual investors buying new issues.
Often less experienced, may be drawn in by the hype, the potential for quick profits, especially during hot markets. Their main protection, Graham says, often relies purely on the ethics of the underwriting firm.
And history shows even reputable firms sometimes get caught up in speculative bubbles, selling lower quality stuff at inflated prices.
Unfortunately, yes, it's a recurring theme. So the message again is, consider the source, even respected investment banks, but always apply your own independent judgment. Don't just take their word for it.
Okay, he briefly touches on a couple of other advice sources too. Local bankers.
He saw them as generally experienced, conservative, potentially a good steadying hand for an unskilled, defensive investor. Not so much for someone hunting for bargains or aggressive growth.
And the classic advice from relatives and friends.
He was pretty blunt about that one.
Yeah.
Basically said the assumption that your friend or cousin has superior investment knowledge is usually wrong. And, quote, much bad advice is given free.
Huh. That definitely resonates. We've probably all been offered that sure thing tip at some point.
Oh, absolutely. Handle with extreme caution.
Okay, so that's Graham's perspective from his time. Now let's bring Jason Zweig's commentary into it, updating things for today.
Zweig adds a lot of valuable modern context. First off, he strongly agrees that a good financial advisor can be incredibly helpful.
But for different reasons than just picking stocks.
Primarily, yes. He emphasizes their role in behavioral coaching, stopping investors from being their own worst enemies. Panic selling in downturns, chasing hot trends at the peak.
Buying high, selling low. The classic mistakes.
Exactly. Plus, help with broader financial planning, retirement, college savings, taxes, estate planning, and avoiding scams, which are sadly still prevalent.
But like Graham, he stresses that finding a good one is the hard part.
That's the crux of it. He points out that most advice is still obtained sort of indirectly, without explicit fees, often leading to just average results. And he really takes aim at the common asset under management, or AUM, fee model.
This is where they charge a percentage of the total money you have with them each year.
Right. Typically around 1%. And Zweig argues this creates all sorts of potential problems. He uses that great dentist analogy.
Oh, yeah. Charging based on your bank balance, not the work needed.
Exactly. It incentivizes the advisor based on how much money you have, not necessarily the quality or suitability of the advice. It can push them towards taking more risk to grow the assets, or towards selling in-house products that might not be best for you.
And it often means you're paying a lot for basic fund picking, which is cheap elsewhere, while the really valuable financial planning might not be compensated properly.
That's his point. The incentives can be misaligned. And he notes that even as investment costs themselves have plummeted, think index funds, these 1% AUM fees haven't really budged much.
Which does make a lot of sense.
Not really. So he strongly advocates for fee-for-service models. Paying hourly, or a fixed retainer, or a project fee, paying directly for the advice itself. And he says, negotiate. Fees aren't always set in stone.
He also warns about all those fancy titles and awards advisors sometimes display, right?
Oh, yes. He pulls back the curtain on that. Many designations sound impressive, but require minimal coursework or just paying a fee. Some top planner awards are basically just marketing schemes.
He mentions the story of the dog.
Maxwell Tailwagger, the dachshund who got named one of America's top financial planners. It perfectly illustrates how meaningless some of these accolades can be. Don't be overly swayed by a wall of certificates.
Okay, so practically speaking, when you're actually looking for an advisor, what steps does Zweig recommend?
First, be clear on what you need. Is it mostly investment management, or do you need that broader financial planning help?
Then the big one, fiduciary duty.
Absolutely crucial. Insist on an advisor who is legally obligated to act in your best interest at all times. Get it in writing. He suggests checking resources like napfa.org or letsmakefun.org for fee-only fiduciaries.
And then the background checks. Really dig in.
Yes. Use NRA's BrokerCheck and the SEC's Advisor Info websites. Look for any disciplinary history, customer complaints, lawsuits, bankruptcies. Don't skip this.
He also mentions reviewing their Form ADV Part 2.
Right. That's a disclosure document. Look for red flags. Fees consistently over 1%, any disciplinary info that conflicts with what they told you, heavy reliance on selling commission-based insurance, getting extra payments for referrals, things like that.
And he flags certain buzzwords to be wary of.
He does. If an advisor frequently talks about annuities, especially complex variable ones, or relies heavily on charting or technical analysis, uses terms like tactical asset allocation or pushes private funds, these can be warning signs.
Why those specifically?
Annuities often have high fees and commissions. Charting technical analysis has dubious predictive value for long-term investors. Tactical trading often leads to higher costs and taxes. Private funds can be very expensive, opaque, and full of conflicts. Be cautious if these dominate the conversation.
Okay, so you've done your research. Now you're interviewing potential advisors. Zweig has specific questions to ask.
Yes, a really helpful list. Key ones include, will you act as a fiduciary at all times, and will you state that in writing? What's your main focus, investments or broader planning? Do you earn more if I buy certain products? What are the total fees if you recommend private funds? Are your fees negotiable? Do you offer hourly or project-based fees? Have you ever been disciplined or sued? Do you believe you can consistently beat the market? What's a reasonable return expectation? Who manages your own money and how?
That's comprehensive. He suggests sending these ahead of time.
Yeah, and maybe setting up a simple spreadsheet to score their answers objectively. Don't just rely on how much you like them.
He also lists some words of warning phrases that should make you immediately skeptical.
Right. Anything that plays on fear or greed, implies certainty, or creates false urgency. Things like proprietary algorithms, guaranteed returns, exclusive access, can't miss opportunity, we consistently outperform. Be very wary of that kind of language.
And after the interview,
Rate their communication style, your overall gut feeling, sure. But then total up your scores from the questions. Hire the advisor who scored highest based on your deliberate evaluation. It's a big decision. Approach it systematically.
okay, wow, that's a lot of ground covered from Graham's time to today's complexities. So boiling it all down, what are the absolute key takeaways for our listeners?
I think first, just recognizing that seeking advice on making money itself is a bit unique in the investment world. Be mindful of that dynamic. Second, understanding the different advisor types and, crucially, their potential incentives and conflicts of interest. Know how they get paid.
Right. Follow the money.
Third, realizing that you need to be an active participant. Critically evaluate advice. Don't just accept it passively. Build your own knowledge base.
Be informed.
And finally, the importance of seeking out and insisting on a fiduciary relationship. Someone legally bound to put your interests first, that's foundational.
Absolutely. So as we finish up this deep dive, maybe a final thought for everyone listening. Given everything we've discussed, all complexities, potential conflicts in the advice world, how can you personally best empower yourself? How can you make sure you're making the best decisions for your own financial future, whether that means finding the right advisor or confidently deciding to manage things yourself?
It's a really personal question.
It is. Something to reflect on, considering your own needs, your comfort level with risk, and everything you've learned today. Maybe even dig deeper into fiduciary duty or specific advisor types as a next step.
Definitely worth pondering.